All right, thanks for staying with us. It was a year ago that the flood insurance market exploded. Congress acted, but now homeowners with flood policies are starting to see a second round of increases. The first notices for flood insurance renewals this fall are hitting Florida mailboxes. Many who live in their homes will see increases of 18%, but for second homes and rental property, the hike is 25%.
Current rate structure is flawed.
Richard Kuhn is a state insurance regulator. He says Florida pays $4 for every dollar it gets back in claims. In other states, it's 20 cents, which should make offering flood insurance in Florida a potential profit center. State lawmakers approved plans for private companies to offer flood beginning July 1st. Under the law, the companies can charge what the market will bear without first getting approval, but few are jumping in.
It's going to take some time for the private market to move into this space.
Are you surprised that more companies haven't jumped in?
Not necessarily. Sometimes we were pleased to see one particular program, the Flood Insurance Agency in Gainesville.
But an online quote from the agency showed little savings from the national flood prices. The reality is that those homeowners who own their homes outright have just decided to go bare and have no flood insurance. That's what Debbie Logan has been doing. So you don't have flood insurance?
No.
Why?
Because it's too expensive.
And unless more companies come in and offer significantly lower prices, more homeowners will be like Debbie and going without. Reporting in Tallahassee, I'm Mike Vasalenda. As one part of the solution, state lawmakers this year enacted a private flood insurance program encouraging private companies to write flood insurance. So far, that has not taken off, but will it? And then my guest today, Richard Kuhn, the Deputy Insurance Commissioner. So what is the state of private flood insurance in general? Let's start there.
Well, Mike, to back up a little bit, when BW12 passed and we saw the dramatic rate increases that consumers were facing, some consumers were seeing increases 300% or more. Those were primary homes that people were living in those homes. They've got several categories. For example, non-primary is subject to a 25% cap. But it was the primary resident who was being hit with the largest rate increases when they tried to sell their home. When they sold their home, that it was no longer grandfathered in. You've heard people talk about the subsidy and being grandfathered. So what happened is the real estate transactions became stalled. It was difficult to sell a home because a new buyer would have to pay full risk rate. So that's what generated the conversation in October of last year. That was sort of what got the attention of Congress to go back and revisit BW12. And in doing so, they passed the Homeowners Affordability Act in 2014, which caps those rates at 18% for those homes that are primary residents. What it doesn't do, though, is address some of the changes in BW12. For example, the non-primary homes are still subject to a 25% rate increase. There's a lot of different things going on in both those bills, but I think to address the consumer outrage, the cap for the primary residents is 18%.
That is still a pretty good chunk of money for someone who might have been paying $3,000 or so.
It is. It is. There are still going to be rate increases, so I think you're still going to hear some people that aren't very happy with the rate increases they're seeing. But the private market has shown some interest and is offering policies in some cases that are less expensive than the federal program.
Now, how much money are we talking about, and how rare are those prices lower than the federal program?
Well, we've got two companies that came into the market in October of 2013. The office issued a memorandum that sort of walked through some of the issues. We were trying, companies that were interested in maybe exploring this market, we were trying to give them an avenue or a pathway to a way to feasibly come in and market flood and write flood. And the way we did that in this memorandum, we talked about the financial capacity that the company needed to. We needed to see what their financial capacity was. We needed to see what their plan was for developing rates and for developing forms. So that's what the companies that showed interest, one of them in particular, last year that began writing primary flood on their own paper, not through the federal program, Homeowners Choice is one of our companies that chose to look at our memorandum, and what our memorandum does is lays out the loss costs for the federal program rates that were in effect prior to BW12 taking effect. So basically what the company looked at was what they were charging, and this company feels like they can make profit and make money and serve their customers by offering a rate that is based on the old rates before BW12 took effect. So you do have rates that are less than the federal program because obviously they're using a rating scheme that was earlier than the rate changes that took effect in BW12 or that were capped in the subsequent legislation.
And what I found really interesting about this entire debate is that Florida is a donor state and really sends, for every $4 in premiums we collect, only about $1 is coming back to policyholders, which means there's literally 300% profit out there for someone.
Well, that's what we're hearing. For example, the Flood Insurance Agency in Gainesville, Florida, who writes flood on the surplus lines basis, has written significant flood policies in the state. They seem to focus on the non-primary residents. Of course, they're going to have different underwriting, but their program is cheaper, less expensive than a federal program, and they believe that the Florida rates aren't right in the federal program. To your point, we pay $4 for every dollar we get back in the federal program. Other states pay 20 cents and get back, several dollars for what they pay in. So they think that the rating scheme may not be set right, and that's part of what the Homeowners Affordability Act is intended to do, is look at the rating scheme, look at, there's several things they're doing in that study, but they're trying to determine whether or not the rates should be updated the way that they calculate the rates, and I think most people agree it should. And Lloyd's is writing less expensive policies because they believe that those rates are wrong, and they believe that they can make money, and they're doing it through the Flood Insurance Agency in Gainesville, which has been highly successful. They're operating now in 33 states, I believe. So there is some interest in the market, but we'd like to see more companies interested in that
And these
market.
two companies are prior to the state actually enacting the legislation which became effective July 1.
That's true. We met with Mr. Hecht, who represents the Flood Insurance Agency. He actually visited our office in the spring before the October rate increases hit to share his ideas. Even though he didn't have to, he wanted us to know who they were and what they were doing and how they wanted to serve customers. And so he met with us, and they worked out a program, and they're actively writing. And then later, Homeowners Choice, which is an admitted company that actually endorses their homeowner policy with a form to provide coverage that's actually better than what you would get under a federal program, which is another requirement from the federal banking system. They're going to require that your flood policies be at least as broad as the NFIP policy.
And why is there such a disparity between rates in Florida and other states? Is it because there are so many, are we a donor state to the national program because there are so many people insured here and there just aren't that many losses, or?
Well, we represent 37% of the policies in the program. We've got over 2 million policies in Florida, and we've gotten back a fraction of that in claims. So we haven't experienced the claims that other states have. We recognize that their rating program may not be set right. If that program were filed in Florida, we would take issue with the way some of the things are set up. You've got people paying the same rate, yet they're obviously in different territories. That doesn't make a lot of sense. So that's something that the FEMA is looking at in their study under the Homeowners Affordability Act. They're going to look at this issue of rating. They need to use updated models, which newer models are coming out now, which we hope the newer models that now will give information to companies for inland flood and how it reacts, how inland floods occur versus coastal. Most of the modeling that we're seeing are the old coastal models that are ancient. We're hoping that the new models will give companies a tool to use in determining whether or not they want to enter that market, and we're hopeful that that will occur.
All right, we're going to take a quick break. When we come back, we'll discuss the state flood insurance program. And then after that, we'll be talking about homeowners insurance and what you should know about pricing on that. Stay with us. We'll be right back.
Did you buy the flashlight and the batteries?
Yes.
Did you make sure we're not missing anything in the first aid kit?
Yup.
Did you go through the plan with the kids again?
Yes.
The more you prepare today, the more you'll be able to reduce the devastating effects of a tornado, an earthquake, a power outage, or any other disaster. Get a kit, make a plan, be informed. Visit ready.gov.
Come as fast as you can. There is enough wonder here to satisfy the most insatiable explorers. This is a place you must see for yourself.
In 1513, Ponce de Leon shared a little of Florida's sunshine. Now, it's your turn. Invite your friends and family to explore our state at sharealittle sunshine.org.